On August 13th, the S&P 500 reached a record close of 7,798.99, while the Nasdaq hit its own peak. Across the board, the indicators on the New York Stock Exchange floor seem to suggest a market in full stride. This momentum is fueled by a specific narrative, the soft landing. Investors are betting that the economy can cool without collapsing, a belief supported by strong corporate earnings and the massive surge in artificial intelligence development. However, while stocks are celebrating, America's borrowing costs are moving in the opposite direction. These record highs are masking a structural vulnerability. If the current disconnect between stock prices and bond yields continues, the market faces a significantly more volatile path than the current optimism suggests. The number investors must watch is the 10-year U.S. Treasury yield, recently hitting 4.68%. While stocks climb, borrowing costs are rising. Normally, as this historical overlay shows, rising yields make stocks less attractive, dropping their relative value and pressuring valuations. Right now, the stock market is ignoring that rule. Equities are holding near all-time highs, even as the cost of capital increases. We have two massive financial systems telling completely different stories. For average investors, this gap between equity optimism and bond reality represents a severe hidden risk. The 10-year yield is the baseline for the American economy. As it rises, the impact radiates outward, increasing costs for mortgages, companies, and government debt. Investors ignore this pressure through three factors: strong earnings, AI hype, and expectations of future rate cuts. This immunity is fragile. If yields stay high because inflation is persistent rather than because the economy is booming, expensive growth stocks will eventually face a valuation correction. The market has priced in a perfect economic outcome, leaving very little room for error if the cost of borrowing remains at these levels. This chart shows the primary hurdle. U.S. inflation slowed to 3.4%. Geopolitical tensions in the Middle East keep oil markets volatile, as seen with these tankers and high-risk corridors. A spike in oil prices filters directly into higher costs for transportation and manufacturing, eventually raising prices for consumers at the register. This presents a specific risk: the central bank being forced to fight energy-driven inflation at the same time the broader consumer economy is stalling. The conflict between the stock and bond markets will eventually resolve down one of three distinct paths. In Scenario 1, the soft landing, inflation continues to fall toward 2%, while the labor market remains stable. In this case, Treasury yields would likely decline, allowing stocks to continue their climb. Scenario 2 is higher for longer. If inflation remains stuck, the Fed will keep policy tight. In this environment, expensive growth and tech stocks become highly vulnerable to their own high valuations. Scenario 3 is a broader economic slowdown. If consumer spending breaks and unemployment rises, the Fed would be forced to cut rates aggressively, not to help stocks, but to stabilize a struggling economy. Two of these three paths involve significant pressure for a stock market that is currently positioned for the best-case scenario. Rather than watching daily market swings, investors should monitor a dashboard of four specific macroeconomic numbers. First, is inflation moving toward the 2% target? Second, is the labor market showing signs of rising unemployment? Third, keep an eye on the 10-year Treasury yield. And fourth, watch consumer spending to see if Americans are still powering the economy. The American consumer remains the single most important engine keeping the U.S. economy afloat right now. Record highs in the stock market are encouraging, but when equities and bonds tell completely different stories, history suggests it is the bond market that demands the most attention.